discussing big stock market gains and big stock market drawbacks and how they often go hand in hand in this week's fastest 4 minutes in finance. Hello, I'm Scott Inman. Well, I've had quite a few client conversations in the past few weeks about a possible AI bubble. The fearmongers are out telling investors that there's too much optimism over artificial intelligence without enough results, and that doesn't justify the stock valuations. And it might be right, but even if it is, it doesn't mean there's a bubble that's about to burst. It might mean that there will be a stock market correction in the near future, and that would be perfectly normal. At the time of this recording, the S&P 500 index is up about 14% year to date, and that includes digging out of an 18.9% drawdown in the spring. Remember the so-called tariff tantrum? LPL Research has some great perspective that shows us it's not uncommon. In fact, the average drawdown in any given calendar year is 14% since 1980. During that same time period, the index has averaged 10.7% annually. Now here's a closer look using a chart from LPL Research. The blue bars show the S&P 500 annual returns going back to 1980. There have been 35 positive years out of the past 45 years, and 14 times the index pulled back 10% or more during the year. So that means in years with positive returns, 40% of the time, there was a correction during the year. 9 times, there was a 14% or greater pullback during the year. LPL Chief Equity Strategist Jeff Buckbinder says double-digit intra-year declines often come with double-digit annual gains, one of the most powerful messages in investing. And there's a difference between a bubble and a drawdown. A bubble can burst, as it did in the late 90s, into the first decade of the 21st century, commonly known as the dot-com boom and bust. That led to several years of stagnant or even negative performance. But the bubble burst was just a catalyst. In that decade, we also experienced 9/11, 2 wars in Iraq and Afghanistan, and the great financial crisis. As we've illustrated, a drawdown is common and usually short-lived. That's because it's common for investors to get over their skis a little, driving up valuations too much, too quickly, and they need to course correct. Keep this in mind when the next bout of volatility arrives. Keeping perspective can help you avoid doing the wrong thing at the wrong time for the wrong reason.
Want to become smarter financially in 4 minutes or less? Sign up at fastest4.com to get insights and updates like this delivered to your inbox weekly.